You're listening to the Home Ownership Podcast by Movementum Realty, real estate talk for buying, selling, and owning property.
Hey guys, Sean Patrick Maloney here, broker owner of Movementum Realty, located in Hanover, Massachusetts. Welcome to episode 17, Condo Financing. I'm your host, Sean Patrick Maloney. I'm here with Chris Devon of Cross Country Mortgages. He's a top producing mortgage professional within the top 1% of all mortgage professionals in the U.S. for 10 years now, 18 years in the industry, and also the host of Real Estate Talk Boston on Boston.com. Hey Chris, how you doing today?
Sean, thanks for the intro, bud. Appreciate it. Thank you for having me.
Not a problem, Chris. It's always great to have a true professional in an industry on. Love to share with the homeowners all different ideas and stuff. It's one thing for me to talk, but it's really great to be able to bring in an industry professional that can help them further understand things. Today I want to talk about condos. It's becoming a bigger and bigger segment of the entire marketplace in the U.S., especially here in the Northeast. It's kind of newer to us within the past 20 or 30 years, which still makes it new relative as far as talking real estate, but it's actually becoming kind of a streamlined product, and everybody seems to be doing it. I notice in Weymouth, Quincy, every time more than one lot sells, 2 or 3 lots, it doesn't become 2 or 3 houses, it becomes 8 or 10 condos. So It's something that's becoming more and more prevalent in our marketplace. So let's talk about, first off, how is condo life different? We can both talk about this a little and bounce some ideas back and forth.
Sure. I mean, I think it's definitely different in the fact that in a lot of cases with a condo, you're sharing walls, right? Something that a buyer has to think about. It's funny. I recently came across a buyer that I'm working with that's moving out of their home after raising their family and being in it for 30 years. And they are thinking about, being empty nesters and moving into a condo, put an offer on a place, new construction not too far away from their current home. And after having that accepted offer deposit down for a couple months, they ended up withdrawing it. They decided that they don't want to share walls and have somebody live above them. So in this case, I'm glad that they thought of it when they did. I wish they thought of it 2 months earlier, but it's definitely something that you want to think about as a buyer. Condo living is awesome. You don't have to shovel snow. You don't have to cut the grass. You don't have to worry about a lot of the maintenance stuff that you do have to worry about with a single family. However, it can be an adjustment for some people in how to live in sharing space.
Yeah, there's a lot of pros and cons to condo living, and I think obviously you hit on some of the biggest pros. It's that ability to come back from Florida in the middle of the winter and the driveway's already cleaned up, all the way to, you go into the beach in the summertime, you pack your cooler and you walk out and you smell fresh cut grass and you didn't do it. So obviously those are some of the big pros. There's a lot of amenities available. You have some places have pools, or they have a fire pit, or they have common grills that you don't have to maintain, workout facilities, all sorts of different options. But obviously the biggest cons and the biggest things that you want to pay attention to is, does it work for your lifestyle? Are you a late night partier that likes to turn the music up? Do you like to park your cars out on the driveway as well as have a boat out there? Because you may not be able to have a boat in your driveway over at a condo. Most of them you won't be able to. Are you a guy that has a million tools that wants to have a big full garage?
Pets is a big one too.
Yeah, my mother just moved out of a place and you weren't allowed to have anything other than one shovel and your 2 cars in the garage, nothing else. So that when your garage doors were open, it looked pretty for every other neighbor. That's great for some people because they're like, I don't want to do the work myself. But for other people, it's a unique experience when you like to turn a wrench, or you decide that, you want to do some custom flowers out front. So definitely want to look over everything before getting into a condo. But let's talk a little bit more about the finance side. How does one qualify for a condo differently than single family? Like, what's the differences overall in the qualification?
The biggest difference is when you're trying to qualify for a condo is you have a homeowners association fee, an HOA fee, it's called frequently. That condo fee can be anywhere from, a multi-unit conversion in Dorchester, and it might be, $100 a month that just covers roof maintenance and plowing the driveway, versus some of these buildings in the city that are full service buildings they could have condo fees north of $1,000 a month. So that plays into how someone can qualify. Let's just throw out a number. Let's say $400,000 single unit purchase. Somebody's looking at a single family home and a condo. They might not qualify for the same amount or the same price point for that reason. So it's really something that you have to be careful of from town to town, from building to building. When it comes to a condo, those fees can vary drastically, even at the same price point. So, John, what I advise clients to do is definitely connect with their lender. You want to connect to make sure that you're running numbers specific to a property, especially if you think it's on the high side of your budget.
So what I'm understanding that you're saying here, Chris, is that the condo fee is going to go in on the pre-approval and that the condo fee is going to affect the pre-approval for the people.
Correct. It's not literally listed on the piece of paper, but a good lender is going to do their homework and make sure that they're qualifying you for that specific property, using the right taxes, using the right condo fee. That can have a huge difference.
Excellent. So if I'm a seller and I'm getting ready to sell my condo, how would I go about finding out whether we could accept VA or FHA loans on the property?
You can connect with the association and find out if you're FHA or VA approved. If you're not, it's a great thing to bring to the association. Try to get your development FHA, VA approved. It's going to make your unit and your development that much more attractive. There is a process to it. It's labor intensive typically for the agent involved, maybe an attorney involved. Usually takes around 60 days, but will open up your buyer pool significantly.
Excellent. Yeah, so it seems to make sense. I mean, if you're going to be putting it on in order to get maximum money, you want to make sure that you're an FHA or VA approved condominium complex, if at all possible. I mean, sometimes you can't get it done, but you definitely want to do that to open up a bigger pool of buyers. Now,
the high-end stuff in the city and jumbo financing world, it's not going to make sense. But for especially here on the South Shore, anywhere really outside of the immediate city, there's a definite opportunity. There's not a lot of people that have that significant down payment. And when you can cater to the veterans and that low down payment pool of buyers, you're really going to open yourself up to a lot more opportunity, higher prices.
Excellent. So some lenders have difficult issues with new developments. And I know some people live in units and they just bought them, but they live within a development that's not that old. What are some of the things when you're living in not that old of a development you want to look at as far as for a seller?
You want to look at, condo fees. Are there any homeowners that are in the arrears? If there's more than 10% of the current homeowners that have not paid, they're behind, that could be an issue. Owner occupancy is a big one. Okay. If people don't realize that their building is filled with renters, that can be an issue when it comes time to sell. Typically, lenders are going to be looking for greater than 51% owner occupied. It's a very important number. If your development doesn't meet that, there are options for buyers. It's just much more limited. Typically, it's a portfolio loan and you're looking for larger down payments, 15, 20, 30%.
So that seems like a double-edged sword for sure, because I know all the time I go out with buyers and they're looking to get into a place and they're like trying to kind of hedge their bets. Maybe this is a future rental for them, so they want to read that it can be rented. But then again, as you're saying here, you buy in, you have a low rental rate currently, but because they have that rule, that bylaw in there that they can rent, when you go to sell in the future, that same thing that made you buy could be what ultimately burns you in the long run.
Right. And it will put you in the best position possible. If you're walking into a condo to buy with your agent, if you guys are asking the questions up front, is there any commercial space in this development? Are there any late condo fees? What's your owner occupancy? Are there any assessments? You ask just those basic questions, you're going to put yourself in a pretty solid spot to see if this is a building that is lendable and that you really want to buy in.
So during the process, if I'm a home buyer, I'm purchasing a condo, I know you mentioned times to reach out to them. Do you want to just start off with letting your lender know? Is it available for them to, run some numbers just to get an idea? Okay, if I'm pre-approved for $400,000, what does it do at a $500 condo payment, at a $600 condo payment? Is that something that you do for people?
Absolutely. And especially if they're strictly looking at condos. And it depends on where they're looking as well. If they're specific to an area, which some people are, you can really kind of gauge the developments in that area and the range of condo fees. Where it becomes tough is really in the city, because you could have a full service building at a certain price point that's got a condo fee over $1,000, and a brownstone down the street that is the same price point that has a condo fee for $150. So that's something that you want to work through with your agent and your lender to figure out what type of building you're ultimately looking for, and what amenities you would like to have, and then run those numbers with your lender.
If I was a condo owner and I'm a home seller, I'm getting ready to sell, what type of condo docs need to be ready? I hear the word condo docs thrown around a lot. In order to produce the loan, what condo docs are going to be needed?
Right up front, the condo documents, that's what they're actually called, will outline the ins and outs of the development and the association. Those will be needed. The bylaws, the budget, you want to make sure that they have 10% in reserves. There's a questionnaire that needs to be filled out to meet Fannie Freddie requirements, and a copy of the master insurance. These are all items that are typically gathered by the agent with the listing agent. The lender can help, and those are things that are going to be reviewed by underwriting to make sure that the condo is warrantable, it meets guidelines, and that you can lend to that development.
I know in my past history of listing some different condos, there's all different methods. Sometimes it's a management company, and the management company ultimately hosts the documents, and other times it's a small owners association where you reach out and get the documents.
Right.
But do be prepared as a seller. There are some costs involved, especially if you have a management company. I know on one unit, my seller actually had to pay over $400 towards getting their own condo docs, and the unit was only $200-something thousand. So
right.
Overall, it actually was quite an expense, and the only way to get them was this management company. And the good thing about it, though, is these management companies a lot of times host the documents live, and as soon as you pay that fee, they release them to you, where sometimes on an association where they're running by homeowners, you may have to wait until the next association meeting to get them. So that's why when you're selling a condo, you actually got to kind of get out the gate a little bit earlier than you do when you're selling single family, because single family, you can pull your deed instantly, you can do a lot of these things right away. Whereas an association, if they only meet every 30 or every 60 days, you're kind of at their beck and call. And if you can't get it done during that 30 days, you may have to wait another 30 days. So I think it's really important to remember, as a home seller in the condo world, you really want to get on things early and make sure you're prepared before you go on the market, because there's nothing worse than having a buyer on the line and losing them because you can't create the documents as quick as they need for the transaction.
Very true. And that's why it's so important to be working with professionals, working with full-time agents that know what they're doing, that can ask the right questions. If you're a buyer, can get all the correct information together. If you're a seller, to present it to potential buyers and make sure everybody's on the same page. The more information, Sean, that you have gathered up front, the easier it is for everybody. Like anything in life, right?
So obviously, during the whole process of financing a condo, it's no different than in any other type of process. It's important to just keep the mortgage professional in the loop and to make sure you're open with them. One of the big things that I can always advise home sellers and buyers alike is when someone asks for information, provide it. Stop asking the why they need it and start getting on the getting it to them, because if there's one thing I've seen interrupt anything, it's the actual people themselves not producing documents quick enough.
Right. The lender's asking for it for a reason. I always say to our clients, we're just the messengers. We're not trying to bust your chops. Don't take it personally. If we need items from the borrower, from the association, from the developer, whoever it is, you're just best off to get it done immediately because those items are not going to go away.
Chris, I know that your company uses some new technology. When someone's uploading documents, tell me a little bit about how they do that part of the process.
Yeah, I mean, every lender is going to be different. The new way of the world is typically using apps or transfer safe technology that allows you to take pictures from your phone and upload a pay stub, similar to what the banks are doing now with checks and stuff like that. You can do it right from your phone. So we have that technology. And for those people that are old fashioned, sometimes people like to drop it off, or we can print out a UPS label. They can overnight it to us, whatever works best for you.
So certainly no excuse at this point in time in technology and both overnight mail as well as apps to fall behind on these type of documents. So just make sure whether you're a seller or a buyer when you work in this process of condos, we know we have some extended timelines and everything. Make sure that you take care of things early. I want to finish it up with one other question, Chris. Let's talk a little bit about special assessments. They're similar to betterments and things like that. Special assessment, for those who don't know, is when you have a condo fee, but something, whether it be the roof or the windows or anything like that, go and they now need to be replaced, but it isn't within the budget of normal, so a special assessment is issued, which means that the unit owner owes XYZ amount of money and they have to pay it. So tell me a little bit about what these do to the ability to lend on a property.
Right. If a special assessment is in place, and it could be anything, it could be 100, it could be 100,000. Really depends on the price point, the building, the development. It can be handled when you're buying or selling by either side. A lot of times the seller picks it up, closes it out before they sell. And that's really kind of the easiest way to deal with it. Doesn't impact the buyer. If it's being passed off to the buyer, that can impact them from the lending side. Because typically, let's say I had one recently. It was a building in Boston. The unit had a $32,000 assessment on it. And there was a payment, I believe, of $645 over X amount of time. We had to take that loan that they were inheriting and build that into their debt to income ratio, which affected what they qualified for. So it's one of those situations. It's really case by case. But if you want to make your unit more attractive to a buyer, you really want to entertain getting that cleaned up on your side. Otherwise, it could scare away potential buyers.
And I know, obviously, all you home sellers out there, you're looking to get the most money possible for your product. You want to get your home sold for the most money. Similar to anything that's wrong with a property, I always say this, even like for single families, the septic's gone. A buyer's mind, it's $20,000. A builder's mind, it's $12,000. So you lose $8,000 there. When you sell a house with a special assessment on it, I know it's only $32,000, but it may disqualify them at $645 a month. That may disqualify them from somewhere between $70,000 and $120,000. I'm just roughing it on the estimates. Right. On the finance side, which means that you're going to take a $70,000 to $100,000 hit as the seller versus paying a $32,000 bill. And the reason being is that you know that if it's equated into their pre-approval, it's actually going to draw down the amount of money they can lend. This isn't like they're saying, I'm not going to do it. It's just simply their pre-qualification is going to drop down, which means you're going to disqualify quite a big pool of buyers by leaving this enormous fee, which actually you could even write in. I'm not a lawyer, but you can actually write it in to get paid at the closing with the proceeds from the closing prior to the transfer of the title, which ultimately sometimes is the best way to do it.
True.
So thanks for joining me today, Chris. We could go on forever about condos. I look forward to having you in the future. If someone was looking to get a hold of you, where would they head to do that?
Best way to do that, Sean, is just going to my website, chrisdevin.com, CHRISDEVIN.com, and more than happy to help in any way that I can.
Excellent. Well, I look forward to having you in for future episodes. Thanks for joining me today. If anyone out there has any questions, comments, or concerns, or ideas for future episodes, please feel free to reach out to me. I look forward to talking to you next week. Thanks for joining us on the podcast. Make sure to follow us and have a great afternoon.